Hey, what's up, my friend? So in today's video, you will learn how you can be in the top 1% of traders, even if you have tried everything else and failed. Now, for those of you who are new to my channel, you might be wondering, man, who are you? What makes you qualified to even teach or talk about this? Well, here's the thing, right? Unlike other traders who teach you based on theory, I actually walk the talk and put my money where my mouth is. In fact, this is a result, right, of my own live trading account over the last few years. And the strategies, the techniques that you're about to learn, right, are the same stuff that I apply to my own live trading account. So if you want to learn from someone who actually walks the talk, who has money on the line, then today's video is for you. Alright, because you will learn, right, what it takes to be in the top 1% of traders. And the best part is this. It doesn't matter whether you're a forex trader, stock trader, crypto trader, options trader, etc. The strategies, the concepts, and the techniques that I'm about to share with you, right, can be applied to this as well. So with that said, let's get started. Now, if you master market structure, then you will never go hungry again. Just kidding, right? Because without food, I can assure you, you will definitely go hungry, right? Whether you master market structure or not. But here's the deal, because if you can master market structure, then guess what? You'll be able to trade and profit across different market conditions, because market structure will tell you or help you identify what the market is currently doing, so you can adapt the right trading strategy for it. So this means you can profit in a bull market, bear market, or even during a range market. Yeah. So market structure generally has three main types. So let me explain. The first type is what we call an uptrend, right? You might be familiar with it, where the price goes up higher, it makes a pullback, goes up higher, makes a pullback, goes up higher. So this is kind of like a basic template of an uptrend. And if you have traded for a while now, you know that an uptrend sometimes is not as straightforward, because there are times, right, where your uptrend could be something like this. The market goes up higher, it makes a pullback, goes up higher, you thought the price is going to break out of the swing high, and then makes another pullback down lower. So this is what we call a complex pullback. I believe it's a concept, right, that I first learned from Adam Grimes. And then when you thought the market is about to make a downtrend, it then continues up higher. Okay, so this is what we call also an uptrend, but this time around it has a element of a complex pullback to it. And of course, there's another variation of it, is where the market goes up higher, right, and the pullback this time is in the form of a range, a relatively small range like this. It goes into a range, and then some traders will thought, oh man, this is the distribution stage, market is going to collapse lower, and guess what, market then continues up higher. So these are different variations of how the price action can unfold itself during an uptrend. So I just want you to be aware of it. And now, if you look at the charts, right, this is how an uptrend looks like. So this is the chart of our BLD. So you can see again, if you understand per definition of an uptrend, basically it's a series of higher highs and higher lows. You can see this series of higher highs, higher highs, higher highs, higher highs, and higher lows, higher lows, higher lows. And if you look at the pullback, right, it pretty much has unfolded the way I shared with you earlier. You can see that this pullback is more of a range, right, before it breaks out higher. And this is, I will classify it more of a complex pullback. Market makes a pullback, then it goes up higher. People thought it was going to break out of this highs. Guess what? It pulls back one more time before it exploded up higher once again. So you can see that, yes, the market is still in an uptrend, but the uptrend has its own behavior and nuances to it. So this is the first type of market structure that I want you to be familiar with. So now the next question is, where do you look for buying opportunities? So in an uptrend, right, really in an uptrend, you want to, as much as possible, look for buying opportunities, right? Avoid short selling, because the path of least resistance is higher, right? So to identify area of value, to identify buying opportunities is not that difficult. If you look at this chart, the price came down over here, had a bounce up higher, came back down, another bounce up higher, came back down, another bounce, and then before it rallied up higher. Okay, so same thing for here, right? We had a pullback, a move up higher, another pullback down lower, another move up higher. So you can see that this consecutive bounce in a row, right, is how we can define it as an area of support. So I'm just going to draw the area of support on the chart over here. This is it, we have like 3 bounces in a row. This we have like a couple of bounces over here, right? So these are potential area of value, right? Area where buying pressure could step in to push the price higher. In fact, there's another one over here. This is what we call previous resistance, right? This is the previous resistance. Price breaks out of the resistance and came back and retest as support before it exploded up higher. So these are areas on your chart where you can look for buying opportunities. And of course, this isn't the only way to do it, because I'm going to share with you another technique, a technique that I learned from Trader SZ on Twitter, where you can actually use, right, a very useful indicator to help you identify support resistance on the chart. So to do that, I'm just going to bring you to this particular stock called DEC. So this indicator, right, let me just show you how to find it. Just go to indicators and you look for something called the quarterly open, okay? And just look for this one, just quarter, just look quarter open. Yep, this should be the one. Yeah, click on this. Okay, then you can see a series of dots coming up. So I'm just sharing with you how to adjust this. Just go to settings, show the quarterly open, right? So of course you use the monthly open, weekly open, quarterly open. I find the quarterly open is very good levels, right, to identify potential area of support resistance on the chart if you trade off the 8-hour daily time frame. So let me quickly walk you through how this works. So you can see that a series of dotted lines on the chart over here. This pretty much tells you the quarterly open. So you can see that right now we are at this price point, right? Why is this dotted line being drawn from here all the way down to this side over here? Because the quarterly open, right, for the month of I believe it's July, open over here. Okay, so you can see that that's how the indicator pretty much plot the quarterly open, the first trading day of July, the opening price, and it just plot it horizontally. So there are 4 quarters in a year, right? January, April, July, and if I'm not wrong, I think October. So every quarter, right, the first trading day, the opening price, that is the level that this indicator plots out and project it, into 3 months ahead. So you can see that over here, how this indicator works. You can see this is the quarterly open, right? I believe sometime in January. I believe this indicator actually uses the closing price of the last trading day of the year. So not that much of a difference, but you can see that when it projected up ahead of time, right? Notice how the price respect the quarterly open. Had a bounce over here, up higher, came back down, bounce up higher. So the same thing for here, right? This is the quarterly open back in April. Then it dropped this indicator over here. Notice how the price came down to this quarterly open and then had a nice bounce up higher. So quarterly open, again, is a very useful tool. Again, something I learned from Trader SZ on Twitter. It's a useful tool to help you identify potential support resistance on your chart, especially if you are someone who is not good at drawing. Then this indicator will make your life super easy. Now, let's talk about the second type of market structure that you should know. It's what we call a downtrend. So it's actually just the inverse of an uptrend, where a downtrend, the price makes a series of lower highs and lower lows. So something like this, right? You can see lower high, lower high, lower high, and lower low, lower low, lower low. And of course, the complex pullback, the range pullback variation that I shared with you earlier for the uptrend, it applies to the downtrend as well. So in fact, if you just look at this chart over here, let's identify the type of pullbacks together, shall we? So if price heads down lower over here, okay, then we have a pullback, okay, slight mini range over here before it head down lower once again. So you can see over goes up, a small mini range here again before it breaks down lower. So you have a pretty steep pullback, breaks down lower. A relatively small range, breaks down lower. Pulls back, heads down lower. You kind of get my point, yeah? So you can see that the type of pullback that you encounter in an uptrend and the downtrend, similar. So looking at this, right, in the downtrend market structure, what do? Do you look for buying opportunities or selling opportunities? Answer is buying. Just kidding. Selling opportunities. Yeah. So where do you look for selling opportunities? Again, you can look for selling opportunities at an area of resistance, and it's not difficult to spot. Again, just look at where the price got rejected multiple times. So I'm just going to share with you. If you look at this over here, okay, price tested once, twice, 3 times, hit down lower. So to me, this would be an area of resistance that I can draw over here. And in fact, you look left a little bit, you realize that also coincides with an area of support previously tested once, twice, 3 times. Okay, so again, moving on, tested once, twice, 3 times. This again is another area of resistance, right? Price got rejected, right, multiple times around this $19.20 price point. And if you look left a little bit, this is previously an area of support as well. So again, you can just draw that and take that into consideration. This would be an area of resistance. So again, you get my point, yeah? So same thing over here, right? Price tested once over here, area of resistance before it hit down lower. And if you look left again, this market seems to be breaking below support and then retest as resistance once again. So if you look at the price action of different markets carefully, you realize that there are certain patterns, right, that occur regularly. So pay attention to this pattern. So for this pattern, right, or rather for this market, dollar against the Mexican peso on the daily time frame, this is a pattern that I'm seeing. So in future, let's say over here, the market does break below this area of support. So let's say if it does break below it, I would say there's a good chance it could retest previous support, becomes resistance. Yeah, so this is how you draw your area of value when the market is in a downtrend. And of course, you can use your quarterly open, right, indicator which I shared with you earlier as well is actually shown on this chart already, right? The quarterly open are being plotted over here for you. So just to walk you through a quick trading example. So let's say over here, you know that this is the quarterly open, right? And it's also near this area of resistance over here. So let's see what happens next. So for this example, you can see the market breaks above the quarterly open into this highs over here, into this area of resistance. Next, we have this bearish engulf, not really bearish, I think more of a dark cloud cover because it didn't engulf the entire candle. You can see that again, this would be a valid trading setup to go short. Why is that? First thing, trend is in a downtrend. Number two, it came towards the area of resistance. Let's put it R, right? As you see over here. Number three, the area of resistance coincide with the quarterly open. Number four, you have this bearish reversal candlestick pattern over here. So this to me is a high probability trading setup, and I want to take it whenever I see such trading setups over and over and over again till my build, grows down the floor and like Gandalf like that. Yeah. Now, the third and final type of market structure is what we call a range. So a range is simply when the price is not really going anywhere. It's kind of like contained, stuck in a box. So let's say like this. Right, the price goes up, comes down, goes up, comes down, goes up, comes down. So it's kind of like stuck in the box. The price is not making any directional move. So whenever the market is in a range, okay, I know there are a lot of traders, they are perfectly okay to just short at the highs and buy at the low, buy low, sell high. But for me, whenever I see the market is in a range, I like to take a directional bias. Okay, so for example, let's say this market is in a range, right? And then let's say it's going to break out higher. Clearly, right, I don't want to be shorting at resistance because I will likely get stopped out. Instead, what I want to do is to buy at an area of support, right? Now the question is, how do I know which direction the market is likely to break out of so I don't get caught on the wrong side of the move and I can catch, right, the start of a new uptrend or maybe the continuation of the trend. So therein lies the clue, right? The clue here is this, is that you want to go up a higher time frame to get your directional bias. So for example, if you look at this chart over here, this is the chart of dollar against the Indian rupee. Price is contained between these highs, and I'll say this is possibly the lowest of the range. And maybe there's another kind of like mid of the range over here. So now, do you want to be a buyer or seller if you look at a chart like this? Well, you can't tell, right, based on this time frame. So this is where if you go up to a higher time frame, things, right, might look clearer to you. So if you go up to the weekly time frame, boom, right? Now, do you want to be a buyer or seller? I think 99.9% of you seeing this, right, you say, you look for buying opportunities because the trend is up. The market is likely to break out higher. And you'll be right, if you think along those lines, okay? So again, going back to the daily time frame now, you have this so-called inside information. So where do you look for buying opportunities? Well, there are a few ways you can do it, right? So for example, you can look for potential buying opportunities, let's say at this area of value. That's one option. Yeah. So another option is that, again, we can use our quarterly open, our yearly open, right, to give us, help us spot area of value on the chart. So in this case, if I use the yearly open, this is the yearly open that you see over here, right? So this is the 2023 open. So earlier we talked about the quarterly open. That's not the only way to identify support resistance. You can also use the yearly open. So in this case, we have this yearly open that also coincides with this previous resistance, which could become support. So this again, to me, this will be going to be a high probability reversal area. So if we have like a a bullish reversal candlestick pattern, like let's say a hammer, right? Let's say a hammer like this, where the price then quickly reverse and close back up above this area of support. To me, that will be a valid entry trigger to go long. I can go long on the next candle open, stops the distance below this lows, first possible target just before this recent swing high, and maybe have like 50% of my position to hold on to see if the market can break out higher. Right? So this is how I would trade a range market. So, do you know why, right, 99% of traders fail? And if you ask me, right, it's because they have the wrong expectations about trading. If you don't believe me, right, here's what I've come across, right, especially traders on social media. They think that they can become a profitable trader after a few months. They think that they can quit their full-time job and trade full-time with a $500 trading account. They think that they have a reasonable expectations of earning 70, 80, 90% a year, and that's considered reasonable. So if you think about this, trading is a profession. And like any other professional endeavor out there, you need time to get good at it. For example, if you want to be a doctor, that's a profession. A doctor needs to spend 6 years in school studying, then 1 year of internship, then 1 year of housemanship. And after that, you're pretty much qualified as a doctor. And if you want to be a specialist, you need another 6 more years. So you can see that the path, right, to becoming a specialist, right, it's more than 10 years. Or if you want to be a lawyer, depending which country you're from, you probably need at least 5 to 7 years, right, before you can become a full-fledged lawyer. Now, what about a professional trader? Well, Rainer, I'm going to take a weekend course and I'm going to trade full-time next month and be a full-time trader. Doesn't quite make sense, right? So here's the truth. All right, here's the deal, right? You need time before you can become a consistently profitable trader, right? I would say the earliest, the first few years are for making mistakes, are for learning. And if you can survive that learning curve, if you have not given up at that point, and if you can learn and embrace from your mistakes, then the later years are for profit, right? To make profits, to grow your account, to compound your returns over time. And speaking of expectations, do you know what's the one thing to look for if you want a marriage to last? Do you look for brains? Do you look for beauty? Do you look for humor? No. You look for low expectations, right? That explains why I'm happily, right, married even till today. Next, I've learned that there is no such thing as failure, only feedback. And this is what will power through in your darkest days. So for example, right, one of the biggest reasons I feel that, why most traders fail is because they personalize their losses and failures, right? So for example, they feel attacked, they feel stupid, they feel that the market is out to get them, right, whenever they have a losing streak. And when you do that, it's a matter of time, right, before you will quit trading altogether, because who likes to be proven wrong and wrong and wrong over again? So let me give you an example. So a trader might learn a new trading strategy, right? And then he gets a negative result, maybe it's a few losses, and then he would think, man, the trading strategy is not working. Let me go and find a new trading strategy again. And then let's say he encounter losses again. So if you repeat this cycle over and over again, right? New strategy, negative results, new strategy, negative results. It's a matter of time before, you will quit trading altogether, right? This would result in a failure. So do this long enough and I can guarantee you that, almost all traders will give up, okay? So what's the solution? Well, the solution is very simple, is that instead of treating this as failure, you want to look at it as feedback. Now, there is nothing personal about feedback. The market is not trying to attack you. But rather, feedback, if you think about this, is just a sign, right, that whatever you're doing isn't working. So stop doing it.
Whatever it is I'm doing that you don't like, I'll stop doing it.
Okay? And make the necessary change, make the necessary tweaks, and give it another go. If you do this process enough time, there's no reason why you can't find success in the markets unless you give up first. Okay? So take Thomas Edison, for example. He's the guy who invented the light bulb. And the first 1,000 attempts, he didn't fail. He just gotten feedback. Feedback to know that the particular material that he's trying to use to make the light bulb isn't suitable. And eventually, he took in those feedback, make the necessary tweaks and changes, and he found success. He found success using the carbonized bamboo fiber, in case you're wondering. And this is the same for trading. Your first few years, right, you might be losing money, right? Those are not failure. Those are feedback. Feedback to you that whatever you're doing isn't working. So it's going to be silly, right, to still keep doing the same thing over and over again and expecting a different result. So take that feedback with open arms, right? Make the necessary change and tweaks. And there's no reason at all why you won't be able to find success in the markets. So to sum it up, right, this particular concept, you can look at this graph over here. And I like to credit, right, Adam Khoo for it, because this is something that I learned from him many years ago. So let's say you have a trading strategy, okay, and you've traded consistently, but still the results, maybe it's not up to your expectations, it's negative. Well, it's not failure. It's simply feedback. Feedback to you that whatever you're doing isn't working. Maybe you need to overhaul the trading strategy, or maybe it's something minor, you can make some tweaks and changes and give it another go, right? So you go back trading the strategy. Okay, and you get the results, right? And if it's negative again, go back to the drawing board and make the necessary tweaks and changes. And eventually, right, when you do something enough times, right, taking in the feedback, there's no reason why you won't be able to find success. Do you agree? Then smash the thumbs up button and subscribe to the channel. Next up, position sizing. This is one of the lowest hanging fruit in trading because you can master it in 15 minutes. And once you do, you will never blow up another trading account ever again in your trading career if you master position sizing. So what is position sizing? Position sizing basically means, right, how many units of currency or stocks or crypto or whatsoever to buy, such that if the trade hits your stop loss, you will only lose a fraction of your trading account, like 1%, 2% at most. And the reason why you want to only lose a fraction of your trading account is because if you lose too much capital, it can reach to a point where it's hard to get back to break even. So for example, you look at this table over here. If you lose 10% of your trading capital, guess what? You need 11% to get back to break even. Might not seem a lot, but if let's say you lose 50% of your trading account, you need 100% return to get back to break even. And as you can see, right, as your drawdown gets deeper, as your losses get deeper, the percentage to recover gets even higher, to a point that, let's say you lose 90% of your account, you need like 900% to get back to break even, which is, near impossible. So this is why we want to master position sizing, so that we don't end up in this scenario. Make sense? So now the question is, how do you calculate the position size of each trade such that even if it's a loss, it's only a fraction of your account? So I'm going to walk you through how to do it step by step, and it's not difficult. Give me a few minutes and this skill is going to pay you dividends for the rest of your life. So for example, for those of you who trade Forex, I'm going to walk you through an example. Let's say you're going to trade this currency pair, euro against the US dollar. You can choose, right, the currency pair that you're trading. Let's say your account size is in US dollar. I think for most of you, it's in US dollar. Let's say your account is $5,000. Okay, and you want to risk 1% of your account, just put in 1%. Or if you want to change this into a dollar term, you can put in a swap with money and you want to risk $50, that's possible as well. But I think the percentage one will be, I think, easier to understand, right? 1% of your account. So let's say your stop loss is 25 pips when trading this currency pair. Then now the question is, how many units of Euro USD should you trade such that if the trade hits your stop loss, hits your 25 pip stop loss, that is only a loss of 1% of your account. That is only a loss of $50 to your account. Just click calculate and there you have it, right? You'll spit out the numbers, which is 20,000 units or about 0.2 lots of Euro USD that you can trade. And that's the position size that you should be entering into your brokerage account. Okay, that's how you calculate position size. And for those of you who trade stocks, all is not lost because there is also a stock position size calculator. Just Google stock position size calculator. This is one of the first few that turn up. Let's say your account size for stock trading is $20,000. You want to risk, for example, 2% risk on the account. Let's say your entry price is $20. Your stop loss is at $15. Risk to reward, let's say just put 1-to-1. Your fees, let's just ignore the fees for now. Let's put 0. Slippage, just put 0, right? If you know what those numbers are, you can put it. If not, just leave it as 0. Then just click calculate. And there you have it. It says that you can buy 80 shares, right, of this particular trade that you are taking. You can buy 80 shares of this particular stock, right, that you're trading, right? Such that if the stock hits your stop loss, you lose, right, not more than 2% of your trading account. So in this case, it will be about $400 on this trade. Does it make sense? As you can see, right, this is a very, very important skill set and it's not difficult to master. And once you master it, right, there's a good chance that you'll never blow up another trading account ever again. Moving on, okay, the next one is, if you fail to plan, you plan to fail. So let me ask you, do you know the reason why, so many traders lose money in the markets? Here's why. Right, you look at a chart and then they see a series of big bullish candles, bam, 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 3 big candles in a row, and they would think to themselves, man, Rainer, look how bullish this price action is. Let me just buy, right, and catch a small piece of the move. I'll quickly get out of the trade before the market reverses against me. Now, what is the problem with this? Well, simple, right? Let me ask you. If the market were to reverse against you shortly after you hit buy, where do you exit? If the market, let's say, does move in your favor, when will you take profits? Or if the market moves in your favor and then it starts to reverse against you, do you hold on to that position thinking that you will continue higher, or do you exit the trade, right, for whatever small profits or a small loss that you've incurred? So can you see where I'm coming from? If you can't answer any of the questions that I asked earlier, then it means that you have failed to plan. And this is why if you don't go out there, you see families with many kids, 3, 4, 5, 6, 7 kids, clearly the couple probably failed to plan. Right, that explains why I have 3 kids myself. So anyway, how do you avoid getting caught in this situation, right, where the market catch you off guard? So I'm going to share with you this very simple checklist, right? So no matter what the market throws at you, you're always prepared. First one, do you know why you are entering a trade? That's the first question. So the answer is very simple. It has to be because you're following your trading plan, your trading rule, your trading strategy. Anything else like, FOMO, the fear of missing out, itchy fingers, boredom, Wrong answer, and you shouldn't be entering the trade at all. Second one is this. Do you know where to get out if you are wrong? Because let's face it, right? The trading setup could be, perfect. All the stars are aligned and you could still get it wrong. The market could still turn against you. So when do you get out if you are wrong? So a very simple rule that I follow is to actually set your stops at a level where your trading setup is invalidated. So let me explain. So let's say you buy when the price comes into support. Let's say it comes into support, it bounces off, you buy. So at which price point on this chart will your trading idea be invalidated? Well, clearly, if the price breaks below support, right, then your trading setup is invalidated. So your stop loss will be somewhere about here, right? Let's put it SL. So if the market, let's say it comes down lower, hit your stop loss, clearly at this point, the area of support is gone, it's broken. You should then get out of the trade. Third thing, if you are wrong, is the loss a fraction of your account? So ideally, right, you want to make sure that your loss, right, is not more than 1% of your account. So this way you incur 4, 5, 6, 7 loss in a row. It's still not the end of the world because it's only a fraction of your account. And finally, do you know when to get out if you are right? What if the market starts to move in your favor? Where do you take profits? The last thing you want to do is to hold the trade forever and then watch it come back to your entry, hit your stop loss, and then all gone. Right? So a technique that you can consider is to let's say again, market is in a range, then it comes down to this area of support, it goes up higher, you buy. So usually, if you want to capture a swing, right, you can look to exit your trade before opposing pressure steps in. So let's say you buy near support, where might opposing pressure come in is at this area of resistance. So somewhere about here, right, over here, right, could be your TP, your take profit level, to exit your trade before the opposing pressure steps in. So this is where you get out if you are right. Okay, so before I go, let's do a quick recap, shall we? So to be in the top 1% of traders, there are a few things that you need to have. Number one, to understand market structure. So market structure pretty much refers to what the market is currently doing, whether it's in an uptrend, downtrend, or range. If the market is in an uptrend, we want to look for buying opportunities. And if the market is in a downtrend, we want to look for selling opportunities. Because if you can trade along the path of least resistance, you will put the odds in your favor. Number two, have the right expectations. Trading is not a get-rich-quick scheme, right? Your first few years are pretty much for learning, and the later years are for profit. Third thing, there's no such thing as failure, only feedback. That is the mindset, right? The top 1% of traders adopt. And if you can adopt this mindset, you realize that your trading will improve. Your life will improve. If you are running a business, your business will improve, right? Because it's a philosophy, right, that you want to embrace, not just in trading, but in other aspects of life as well. Number four, position sizing. So this is one of the easiest skill to master, and it's going to pay you dividends for the rest of your trading career. Because if you master it in like less than 10 minutes, it will be unlikely, right, that you'll ever blow up a trading account unless a black swan happens to you, right? Black swan event. And finally, have a bulletproof plan. This means you know when exactly to enter a trade, when to exit if the market moves against you, when to exit if the market moves in your favor, etc. And by the way, if you're enjoying this training so far, then I'd like to invite you to my free upcoming webinar called Stock Trading Secrets, where in this webinar, right, I'll share with you a proven stock trading system that has generated 3,225% over the last 22 years. I'll give you the exact trading rules, entries, exits, etc. Plus, we'll talk about how you can, grow a small trading account to 6 figures, 7 figures, and beyond, even if you have a small starting capital. How you can actually profit in bull and bear markets, even during a recession. So all these strategies and concepts will be covered in this upcoming webinar. So I'll put the link below this video. Sign up for it. It is free, and I will talk to you soon.